Dr. Babasaheb Ambedkar Open University.
Hello friends, welcome again in the course of Fundamental of Financial Accounting. Today we have my units of discussion is accounting equation. In the last few lectures, we were just trying to understand how the accounting entries can be identified of each transactions, and then all each transactions are recorded in the books of accounts in the form of journal entries. So that was the first book of accounting concept or accounting transactions. Here we are going to understand accounting equation, which is also partly related with the journal entries. It would helpful to all of you that how this accounting entries to be divided and how the amount will be actually bifurcated of each particular event or each particular transaction or each particular entry, and then how it would be impacted when it is debited and credited to the particular part. I just want to recall all of you when we were actually discussing about the principle and concepts of accounting, the one of the concepts we were actually trying to understand, that is accounting equation, that is dual concept. So that each transactions have a minimum two effects, and that is one is debit and the other one is credit. And that other debit and credit would be actually impacted on the formula of A is equal to C plus L. That was an equation. A is assets, C is capital, and L is liability. So the equation is A is equal to C plus L. A, it's considered an assets, and the other part is C is capital and liabilities. So whatever the changes are made on capital and liabilities, that capital and liabilities changes would automatically reflected on assets. At the end of these transactions, A is equal to C plus L should be happen. So that means the assets is equal to capital and liabilities remains same, can't be differ. So this is what we want to understand in this particular unit. So let's begin with this particular part and how the important topics to be discussed in this particular unit. Like first is accounting equation. As I mentioned you, the equation is A is equal to C plus L. A is an assets is equal to capital plus liabilities. Rules of debit and credit, which you are already aware about it, but then still it will be repeated here because of just wanted to recall how this rules of debit and credit is actually implied on the three different accounts like personal, real and nominal. And after this A is equal to C plus L will be impacted on that. The types of accounts, as I mentioned, that is personal, real and nominal, that is also here. Then the transaction analysis, we need to understand the analysis of the transactions. Once we will find out the transactions, then the transaction has to be divided into a twofold effect. After it would be divided into a twofold effect, then we need to identify which one is debit and credit. Then we need to identify how it would be impacted on this formula, A is equal to C plus L. And at the end, what would be the results. This is what we are going to discuss in the transaction analysis, and then how it will be practically implicated on this particular equation. Now, introduction to the accounting equation is, the accounting equation, as I mentioned, is assets is equal to capital and liabilities. A is equal to C plus L. So this is an accounting equation. How this accounting equation is actually important? A very simple way. Suppose if you are actually brought capital in the business in the form of cash or in the form of any assets. So cash comes in, it is an assets. If you are again brought in the business like plant, machinery, land, building, furniture, vehicles, etc. All these are assets. So it would be impacted on assets. So assets plus, because of assets increasing. When you actually brought all these assets in the business, assets plus, assets increasing. And all these cash assets are actually brought in the business in the form of capital. So the capital is also increasing. So suppose if you brought 50,000 rupees cash and around 1 lakh rupees, it's an assets. The total amount you brought in the business is 150,000. So it means 1,50,000 rupees brought assets in the business in the form of capital. So how much assets will be here? 150,000. What would be the capital? Again 150,000. What is the liability? 0, nil. So as I mentioned you, the equal amount of both the side should be tally. So this is what the accounting equation is actually practically implicated. All accounting is built on the 3 core terms, that is assets, liabilities and capital, as it is mentioned here. And then again amount of the claims, outsiders plus proprietors. Liabilities, it's considered outsiders. That means those who are actually giving or lending money in the business or giving the money to the business on maybe it's considered as a part of a debt or in the form of some credit or any form. Ultimately, it's considered as a liabilities, correct? And proprietors means those person who are actually invested their own money in the business, that's considered as a capital, right? And equal of those all these things invested in the business to run a business, it's considered an assets. Moving next, so this is the equation, how equation would be considered. Moving to the next part is, that is computation of the accounting equation, how this accounting equation is works. Ultimately, example was very clearly mentioned. The business received funds from the proprietors or maybe a creditors, retaining them as various assets. Maybe when you are actually brought all assets in the business, or maybe the cash comes in the business, or maybe you actually create some debts for the business. Maybe you are taking a loan from the bank or a financial institution or XYZ anywhere. Ultimately, all these things were actually brought into the business and it will be retained in the business, various assets in the form of various assets. So this is the formula were directly implicated. Any change in the assets or liabilities causes a corresponding change in the capital, correct? Any change in the assets and liabilities, it will be automatically impacted on capital. That is why the A is equal to C plus L is very important. Suppose if you sold assets, assets will be decreased. Because of assets goes out, assets will be decreases. The simultaneously, in case of the assets goes out, when you assets sold out, so simultaneously assets, one asset is decreasing, the other assets is also increasing. Like you sold out machinery, so machinery will be decreases. But you sold out in the form of cash or maybe received through check, then your cash or maybe a bank balance will be increasing. So the total assets will be remain same, but your assets, one asset is decreased, other assets is increasing. So that is why the capital and assets, any kind of changes in assets and liabilities would be impacted directly or indirectly on capital, correct? Moving to the next point. Now, the next is rules of debit and credit. The rules of debit and credit is actually works here, very simple way. Based on A is equal to C plus L, the rules govern how every transaction is recorded. Left side of equation is considered an assets, right? In case of assets increase, so it's considered debit, a very simple formula. In case of the assets increase, assets debit, or in case of assets decrease, it's considered a credit. It's a simple formula. The right side of the equation, liabilities and capital. In case of any liabilities increase, reverse. Here the the thing is when assets increase, it was debit. When the liability increase, it's credit, and the liability decrease, it's considered a debit, right? So assets and expenses, debit increases and credit decreases, that is, and in case of a capital and incomes, credit increases and debit decreases. So this is the formula where you are actually applying this formula in the particular transaction. Moving to the next point, types of accounts. And the types of accounts are, as main types of accounts is actually, you know that is personal account, a real account and the nominal account. Now, on the basis of a personal, real and nominal account, in case of an assets account which are related to real account, all assets are related to real account. The very simple way, it's considered when the assets comes in, assets increasing, it's debit. When the assets goes out, when assets decreasing, it's credit. Very simple. Assets comes in, so assets increasing, so it's debit. When the assets sold out, assets decreasing, it's considered a credit. The another one is liability account. The liability in case of a personal, Or if it is personal liabilities, it is reflected to a personal account. Credit, it means the giver. When they are giver, so that means credit. The liability increasing, it's considered a credit. So the liability, the person who is giver, liability is increasing, so it's considered credit. When they were actually received the amount of settlement of their outstanding, so that means they are receiver. So receiver in this case, they are debit because of the liability decreasing. So in case of increased liabilities, it's considered credit. When the liability decreasing, it's considered a debit. If you want to reflect with this personal account, you can consider the liabilities with the personal account. When they are actually receiver, it is debit. That is why, because of it's decreasing. And when they are giver, so when they are offering you more liabilities, their liabilities are increasing. That's why it's considered a credit. Capital account, again it is personal because of the person who brought the capital in the business. So it's a capital account, it's a personal account. The personal account of the person who brought the capital in the business. Definitely, if they brought the capital in the form of capital like cash, bank, or maybe in assets, then again it would be affected real account. But the capital precisely, it's considered the personal account. Now, the capital comes in, the person's capital comes in, so who is a giver? Owner is a giver. Owner is a giver, that means his account is credit. So that's why capital is increasing, it's credit. So when the capital increase, person is giver, it's considered credit. When the person is actually brought the capital out of the business, or maybe he withdrawn the capital from the business, or it's considered a drawings, any forms. Maybe it's considered a drawings, or maybe a capital withdraw from the business. Ultimately, capital reducing. Who is a receiver? Owner is a receiver. Proprietor is a receiver. So he is a receiver. The receiver is, as per the personal account, receiver is debit. That's why capital account is. In the case of capital is decreasing, it's considered debit. Revenue and income, it's affected in nominal account. Any kind of a revenue, it's your income. So as per the nominal account, revenue, income, it's increase, it's always credit. So any revenue received, income received, it's increasing, that's why it's credit. When the revenue and income maybe not receiving or it decreasing, that is why it is debit. Reverse, in case of an expense and losses, again it's related to a nominal account. Any part of expenses increasing, it's debit because of expenses. And anyway also, if it is increasing, the arrow sign is very clearly defined. When the expense is increasing, it's considered debit. Or any kind of expenses decreasing, it's considered a credit balance. So it's a credit ultimately, not a balance, but it's considered as a credit. So these are the basic types of accounts, is personal, real and nominal. But there's some more bifurcation how it would be affected in the formula of A is equal to C plus L. These are the basic accounts which will be affected to the A is equal to C plus L. Moving to the next part. Now, the next is how the transaction analysis, but how the transactions would take place. Let's see how this actually affected in this particular account. On which side will increase in the following accounts will be recorded in the all mentioned nature accounts. So these are the nature of accounts. First is cash. In case of a cash balance, so it's always cash is considered an assets. If you want to bifurcate clearly which one is assets and liabilities, so these are the nature of items, nature of the accounts, right? Then the assets, whether it will be affected, the assets or liabilities, the how assets will be affected and the liabilities will be affected. So let's begin with the first nature of item, that is account, it's cash. The cash is always affected to the assets. Cash always affected to assets. Here it is written debit. So we presume that the cash comes in. So cash comes in, it's debit, so it's always increasing. But in case of the cash goes out, cash decreasing, then the cash will be credit. Correct? Very simple formula. The cash comes in, so cash balance is increasing, so cash is debit. In case of asset, because of assets always debit. Assets always debit. So that's why the cash is considered assets debit. The next nature is furniture. Again, furniture, it's an assets. So assets is considered debit. But if it is comes in, furniture, assets account is always debit. But suppose if the furniture sold out, so furniture goes out, so in that case, the furniture will be credit. So in the assets, it will goes out, So that's why the furniture account is credit. Next is debtor. Again, the debtor is considered, it's an assets. So that's why as per the assets is debit. So debtor is created when we sold the goods to the person on a credit basis, and the person will be paid this amount after some time or after some days. So the debtor is created. So debtors, it means the person who is actually supposed to pay the amount to you on a specific period of time. So the debtors were created, and debtors were actually your assets, it's current assets, that's why it's debit. But after some time, when the debtors settled their account and paid off the amount, so at those point of time, they settled their accounts and paid off it, so debtors account will be reverse, credit. But the actual nature of the account is debit. So these are the assets, assets always debit. Basic nature of this account is debit. But in this particular scenario, whenever they were actually settled down or switch off the transactions, all accounts will be reversed. So when the cash is receiving, it's debit. But when it goes out, it's credit, like that. Next is creditor. It's opposite of debtors. The creditor means when you purchase the goods from your vendors on credit, means those amount which have to be payable in certain period of time or maybe on a specific period of time. It means that that is your debt, that is your liability. So liability has to be paid to them. So the nature of this expense or nature of this item is, account is credit, and it's a liability. And that's why it's written here credit, liability. But whenever you settle this account and paid off, when your liabilities is paid off, debt over. So on those point of time, the creditors will be reversed. Creditor has to be debited. Next is proprietor's account. Proprietor's account, it means it's capital. So capital, basic nature of the proprietor's account is credit. So it has to be considered as a credit, liability side, and it's a credit. But when you actually, proprietor brought the capital in the business, it's credit. But when they withdraw the capital from the business, it's reverse, it is debit. Next is interest received. It's an income. Interest received, it's income. Income, nominal account, income is always credit. That's basic nature of this interest. Anyway also it's received. So interest received, it's considered credit as an income. It is not a liability, it is income, that's why it's credit. Wages paid. Wages is an example, it's an expense. Wages paid, it's an expense. So as per the nominal account, expenses, it's paid or it is expense, that's why the expense are debited. So here that wages paid, debit, expense. It is not an assets, it is expenses, that's why it's debit. So the nature of these particular items are different, and on the basis of their nature, it would be impacted on the equation of the transaction. So moving to the next slide, that is the transaction. Once you understand the transaction analysis, now we'll try to understand how these transactions will be impacted practically. So here we'll take one by one all the transactions, and it will be impacted in the formula of A is equal to C plus L, and at the end of the transactions, what will be the impact of your balance, or what would be the impact on your formula. Let's begin with the first transaction. Commence business with cash of rupees 20,000. So the cash comes in, and it is, cash is your asset, so it will affected on assets. Cash account debit 20,000 rupees. There is no stock and furniture, so that's why it's zero. There is no change on creditors or liabilities because of you brought the capital in the business, so it's affected on capital. So here in the last column, the capital is 20,000 rupees because of the capital, it is coming in the form of capital. Next is goods purchased on credit, it is rupees 7,000. So goods purchased on credit, goods comes in, inventories is increasing, so it's written 7,000 in the stock, it's plus increasing. There is no change in the other assets, so is zero, but it is purchasing on credit. It's a credit transaction, so it's purchasing on credit. It is increasing your debt, liability. So it's impacted on liabilities, not in capital. So liability is increasing, so it is written 7,000 in the creditors column, 7,000 rupees. It's increasing. Moving the next is, before we moving to the next transaction, we'll just find out what would be the equation after these two transaction. The new equation after this transaction is, your cash is 20,000. Your stock is 7,000, so your total assets is 27,000. Your total assets is 27,000, equal to the liabilities is 7,000 and the capital is 20,000. So both the side is balanced. A is equal to C plus L is done. Total assets is actually 27,000 against your capital and liabilities. Moving to the next transaction, furniture purchase. It is purchase mention, nothing is mentioned, so we consider it's a cash transaction. So purchase, furniture comes in, cash goes out, furniture increase, any assets increase, it's plus, correct? So furniture purchase, furniture increase, furniture purchase, it's increasing debit. That's another thing is, it is cash purchase, so cash goes out, your cash balance goes out, its cash balance is decreasing, so the minus 3,000 rupees from the cash balance. So this transaction is affected only on asset side. There will be no change on the capital and liability side. So after this transaction equation is, cash balance will be reducing by 3,000, it's 7,000. Stock is remain same, 7,000, no change. And new item comes into the picture, that is furniture, 3,000 rupees. The total amount of this is 27,000. There are no changes after these transactions on the capital and liability side. Next transaction is paid to creditors. Paid to creditors is rupees 2,000. So ultimately 2,000 rupees goes out, cash goes out. When the cash goes out, cash balance decreasing, so it's minus. So from the cash balance, 2,000 rupees minus, no changes in other assets. And we paid to creditors, so creditors, liability is also decreasing, so minus. When you actually decreasing a liability, it is credit. So that's why the 2,000 minus from it, and there is no change on the capital. So the new equation after that, the cash balance is 17 minus 2, 15,000. No change in stock, no change in furniture. The total will be debited is 25,000. On the other side, 5,000 it's your liability after this, and 20,000 rupees it's your capital. Credit side is also 25,000. So equation is matched. Moving to the next transaction, amount withdrawn by the proprietor. So how much amount withdraw? It's 4,000 rupees. Amount withdrawn by a proprietor. So it's always considered either maybe a drawings or maybe it's considered reduce your capital. Again, amount withdraw from the business. So cash goes out. So cash balance is decreasing. When it is decreasing, assets decreasing, it should be minus. So that's why the 4,000 minus from the cash balance. No change in other assets. So as it is. No change in creditors also. So as it is. And other liabilities also as it is. The only change is the capital, because of you brought the capital, it's increasing. But when you withdrawing from the capital, either maybe consider a drawing or maybe the capital is reducing. So minus from the capital. So after this particular transaction, your capital is reducing and it comes to 16,000. No changes in other liabilities, will be remain same. Here also your cash balance is decreasing and no changes in other assets. Moving to the next transaction is creditors accepted a bill of certain amount. It is 1,500 rupees of bill. So there are some creditors. From the creditors, 1,500 rupees of the creditors were returned a bill, and the person who are ready to pay, that means we are ready to accept this bill and accepted a bill after a period of specific time. So creditors will be reducing because of it's converted into a bills payable. So 1,500 rupees minus from the creditors, and the bills payable column will be 1,500 rupees. Ultimately, this transaction is affected only on liability side. There will be no change on the asset side. So 1,500 rupees minus from the creditors and 1,500 rupees will be showing as a bills payable. There is no change in the capital also, but it is the changing in the liability. Moving to the next transaction, definitely after this equation, after particular this transaction, new equation will be no change in assets as it is, no change in capital as it is, only the changes, creditors will be deducted 1,500 and the new item add 1,500 as a bills payable. Interest on capital. Again, this transaction is actually, you can say it's an internal transaction ultimately, because of this would not be affected on assets. It's only affected to the capital because of interest on capital. It's considered an expense. So it's reducing your profit. It's reducing your profit. Ultimately, the profit will be credited to the capital. So once the interest on capital is paid, reducing your profit, so less amount of profit will be added to the capital. And interest on capital, it's an income for capital, so added into a capital. So effect is very simple, minus from the interest on capital as an reducing of profit, and added of interest on capital, it's considered their income. So minus 1,000 and plus 1,000 affected to the capital only. There will be no change on the capital. All remaining liabilities as it is, as well as the assets are also no change. Next is transfer from capital to loan. some amount they transfer from capital to loan. So how much they transfer from capital to loan? It's 5,000. So 5,000 rupees is actually converted from capital to loan. It's converted to capital into loan minus from the capital. So reducing your capital, and you converted your capital into a debt. So new account will be created, loan. Ultimately, it's changing only on the other side, liabilities and capital. There are no changes in the asset side. Even no assets will be changed because of no cash comes in, no cash goes out. Even no other assets are also changing. So same remains, no change. But liability is increasing because of it is converted into a debt. Bank loan is one kind of debt. It's not a bank loan, it's a loan, a proprietor's loan, but it's a debt. So that's why the liability increasing, and capital is reducing because of we converted capital into liability. So if you, after this transaction, you find out the equation, there are no changes in the all assets are remain same, but changes in the capital as well as the liabilities. Creditors are remain same, bills payable is remain same, but if you are going to see this, that there is new item, it is a proprietor's loan, and other thing is capital, that is also changed because of the capital is reducing due to converting into a loan. Moving to the next transaction, creditors converted into a loan. Now this is something unique. Creditors is converted into a loan. So here we just need to find out the how much it's converted into a loan. It's 1,000 rupees. So 1,000 rupees of creditors, they are converting their liability into a loan. So it might be, this creditors is actually having a short-term liability, but once you are converted into a loan, that means you are ready to extend it more than 1 year. Or maybe you are giving a loan in the form of maybe getting some interest also. In case of creditors, there might be no receiving any interest, but in case of converting into loan, you will get some income also or interest also. So minus from the creditors, the amount which is converted into a loan and added into a loan account. Again, this transaction is affected only on the liability side. There will be no change on the asset side. So after this transaction, if you are going to see, assets are remain same only. That total amount of assets is 21,000. Now we'll see how much change in the liability side. On the liability sides, if you are going to see 1,000 rupees converted creditors into loan, so net amount of creditors is 2,500. There is on 1,500 bills payable. Then the 6,000 rupees loan, one is 5,000 converted from capital and 1,000 is converted from creditors to loan. So total amount of loan is 6,000 and capital is 11,000. So the total amount of this is actually 21,000. Here also the total amount is 21,000. So here, after this particular all different kind of transactions which are impacted on the formula of A is equal to C plus L, this we want to see what are the changes made accordingly and how the transactions were affected on these assets equal to capital plus liability. So I just want to explain very simple thing that when you are writing a journal entries, the journal entries is actually showing you how accounting transactions has to be recorded in the books of accounts. But this particular formula, I want to explain you how it is impacted on your assets as well as capital and liability. After these transactions, what are the changes made in your business? That is what I want to explain you. I hope you might understand properly and you will practice also in the coming days. All the best wishes and thank you so much.